Recording
know,
is on.
they're out there and people sometimes discuss about things they are not understanding. So I'm super happy to have Gurjeet and Heusser here on the call. I'm very much looking forward to it. It's even for me still some questions or sometimes unclear how things work, especially in the US. So I'm very much looking forward to it. If you have any questions, write them in the chat, please. We can then raise them, or the speakers can take them up themselves. I would propose we summarize them and can discuss it at the end or in between, wherever it's just where it makes sense. Good. From that, I would not hold you any longer and would hand over to Gurjeet for an intro all about ETFs and APs.
Hi, good evening to everyone. Look, I'll give you a quick introduction about myself, and then I'll kick off, like a 101 on ETFs, specifically around Bitcoin. But I've been an ETF trader, market maker for the last 25 years. I've moved into crypto really, in the last 5 years, but I've been following it for the last 10 years. And probably some of the more relevant experience, I would say, was at 21 Shares, which has been bought by Falcon X. And I was head of ETFs and Delta One at both Deutsche Bank for a number of years and Merrill Lynch. And I was at Hubert Bank for 5 years in Munich and then 4 years UniCredit in London, which is quite interesting because they're in the news today. But sort of back to ETFs, the 101 of it is you have to look at it from two sides. If you're a retail user, what you see is the product that you buy may be listed on the London Stock Exchange or Euronext. You see a price of the ETF, which trades between 8 a.m. and 4 or 5 p.m., depending on CET or GMT. You could be buying an ETF, which wraps the S&P 500 index. It could wrap the FTSE 100. And I think what's more interesting for everyone, when it wraps Bitcoin. Typically what you'll have is a asset manager. And in the past, it's kind of been more of the fintech style asset managers who really kicked this off, I'd say early 2017, 18 in Europe. 21 Shares was one of the early ones. So this is kind of where I understand it. And they created a physically backed Bitcoin ETF. I think prior to that, you may have had synthetic ones, but we'll come back to that in a minute. But you basically have special purpose vehicles, SPVs, which hold the Bitcoin for the end user of an ETF. And the ETF gives you one-for-one exposure to Bitcoin. The small difference here is that if you're holding Bitcoin on a ledger, for example, you're not really paying any additional fees. But with an ETF, there is a management fee. You may think that's cheeky, but there is a lot of administration costs, settlement costs behind it. And turning around from being a retail user to being a market maker, this is sort of where it becomes a little bit more interesting. The way I see ETFs is, let's say I'm sitting in a market making seat. I would then, to interact with an asset manager who issues ETFs, I need to become something called an AP, an authorized participant. And basically, this is signing a contract with them to say that I have exclusivity to trade this particular product. Sometimes they choose one market maker over a period of time. It could go from 5 to 20, but usually they just start with 1 or 2. And this means that, we have this exclusivity to go to this specific ETF issuer and go and create and redeem those ETFs for people who do not have that relationship. You could also be a market maker, which means you're providing a two-way quote to a traditional exchange, like the London Stock Exchange, for example. And the creation redemption process is, for me, it's very straightforward. If you want to create units, you, as a market maker, you have to provide the ETF issuer with cash. So that's a cash creation. Or you can provide physical Bitcoin, which is an in-kind creation. And it's basically the opposite way around. If it's a redemption, you can basically post back the ETF to the issuer, and you can request either cash or the Bitcoin. Usually it's dependent on the market maker and how they're hedging their products. But that is a bit of a breakdown between how a retail user of the ETF would look at it and how an AP or a market maker would look at it. And I'm conscious that it's Monday evening and I've said a lot already, but I'm not sure if I should hand over to Patrick to sort of come from his side. And what I'll do is I'll allow that to marinate with everyone so that they may have further questions, or I can continue down this rabbit hole of creations and redemptions and market making and some of the more interesting questions that have come up in the headlines. I won't use specific market maker names, but I know there have been sort of questions around that. So back to you for a moment, Lisa. If you've got further questions for me, please let me know. Or Patrick, if you want to kick off, I'll hand over to you.
Maybe very quickly. So why do we need an AP? Why is there an AP? Why does a person, an individual investor, cannot just buy it with the fund directly?
Yeah, so there's basically, look, as an asset manager, you don't want 1 million retail clients coming to you. So, for example, you have specialists for that. I think in Germany, you've probably got Trade Republic, who are like the aggregators across retail. But the ETF issuer, the level of administration, it wouldn't make sense to keep doing an individual creation redemption. So what happens is the authorized participant collates all of these orders together. And instead of doing 1 million times one ETF creation, you're just sending a 1 million ETF creation to an ETF issuer or redemption. So it's basically more about efficiency.
Okay. So for someone who's never touched an ETF, what happens when now I buy for 1 million the IBIT, the Bitcoin ETF? Where does the money go? Who touches it? Who is involved? And does these Bitcoins really get bought?
Yes, good question. Look, if you buy the ETF unit, you will have exposure to the Bitcoin ETF, providing that the ETF issuer in the prospectus has said it is a physically backed ETF. I know someone's written a question about synthetic ETF. So a physically backed ETF means that the ETF issuer, the asset manager, has to hold the Bitcoin. So let's say the ratio is 1 ETF equals 1 Bitcoin. They have to have it 1-to-1, and it's audited. Not on a monthly basis, not on a weekly basis. It's a daily NAV at the end of the day. So it gets audited. A synthetic one is basically where you might have a derivative behind the ETF. So you could have swap exposure. So the ETF wraps a swap, but somebody else, another market maker, a swap market maker, is actually holding the Bitcoin behind this. And I'll use some more famous products. So UBS, and I know from Deutsche Bank, X-Trackers, our synthetic ETFs were quite popular until there were certain events back in the day, and I'm happy to touch on that as well to make it a little bit more exciting. And so physically backed ETFs hold the Bitcoin. A synthetic one has another layer between it. So you're not actually, the ETF doesn't actually own it. They have exposure to it via another derivative, and it's usually a total return swap.
So why are there synthetic ETFs out there? I mean, it's mostly because it's not efficient to buy the underlying, or it's not efficient to hold the underlying, like commodities, like the one you mentioned from UBS, the UBS CMCI structures, which were successful until they were not anymore. But is there another reason for holding it?
No, that's basically it. So sometimes it can become very difficult to either hedge yourself, or it's just more efficient for the asset manager to use a swap. And sometimes they might get an even better price. So let's say that ETF issuer is working with a swap desk from an investment bank whose speciality is emerging markets. That particular desk might have an axe to give that ETF issuer a much better price because it might end up hedging their books, or it just works well for them. And similarly with Bitcoin, you can have physically or swap backed, and it just depends on that particular ETF issuer and what style of ETF they want to issue.
Just for the non-finance people out there, can you briefly explain what a swap is and why that would even make sense in the first place?
Once again, a swap just it gives you exposure and the swap itself can have an expiration, and within the swap you can have resets. So a 3-month versus 1 year total return swap. It's another synthetic product for people who cannot take either direct access of the stock itself, or they cannot trade any other derivative like an option or a future.
And before you talked about the redemption in kind and also in cash, and I understand that this has been a huge discussion in the past of some ETF issuers who did not allow redemption in kind. So first of all, what are the pros and cons? And secondly, who decides what is possible?
So basically, when you, as an ETF issuer, the team who create this particular product will decide what type of product they want to issue. And coming back to Sana's question, it's always documented in the product prospectus. So, if it's a synthetic or physical, it has to get mentioned in the prospectus, the documentation of that ETF. But back to you, Lisa, it's the ETF issuer who really decides. So the team who come together, the product team, the marketing team, they've probably done some due diligence. They've gone out to clients even before they've issued it and said, hey, if we created this style of product, would you invest? How long would you hold it? So you kind of have a questionnaire that goes out, and you get a soft feeling for your typical clients, because it might not be brand new clients coming into Bitcoin. It might be clients who are already ETF knowledgeable, have used commodity ETFs, ETPs, exchange traded products, exchange traded funds, and might just want now Bitcoin exposure. So it just comes down to the ETF issuer and the style of the ETF they want to issue, and where they think they'll get the most AUM, assets under management.
Very quickly, what is nowadays in the traditional market, in traditional ETFs, what is the share of physical and synthetic replication?
So yeah, I think after certain events over 10 or 15 years ago, you're basically looking at, I'd say it's easily 70 to 80% physical. I think clients feel a bit more comfortable after the GFC, the global financial crisis, when they started to realize, not just for ETF, but other products. So clients may have traded structured certificate products. They didn't realize there were other derivatives behind that. So this is where ETFs really kicked off in popularity, because once the ETF issuers realized there was a demand for people to have exposure, but have trust that the physical was always there. And it is there. So even if it's an ETF issuer, let's just use a famous one like BlackRock, their ETF umbrella is iShares. And if anything happened to BlackRock, iShares is an umbrella, and that could always be sold off to Vanguard because the physical assets are still there.
Yeah, and I think most of the people really thought like, oh, I want to have exposure to the FTSE, to any index, and then they bought the ETF because they thought, oh, then they will buy the shares for me instead of I buy all the SMI stocks. I buy one product and then they will replicate it behind. But then during the financial crisis, they realized that, oh, there's nothing behind except swaps. And swaps were at that time not really known, right?
Absolutely.
Maybe a last question then to Gurjeet, before we might move on to Patrick to hear his point of view, and then we can condense. So my question would be, as a representative of the audience, so are there any structural weaknesses in ETF design that Bitcoiners should pay attention to?
I'd say, look, the ETF itself, like a BlackRock ETF, it's physically backed. And if you've got an asset manager who's sitting on trillions, I don't think there's that much risk. One of the things that is important is that the ETF, because it is a product sitting on top of the physical, it can trade at a premium or discount to the Bitcoin itself. So if there's a lot of demand throughout the day, the ETF could trade above where the Bitcoin exposure really is. Mm-hmm. And if there's a lot of selling in a day, then the ETF can trade below. It typically gets, the market makers will arbitrage that back into place. So that's something to note. it's always good to notice the the total expense ratio. They range from 20 basis points to 2%. It really depends. And I'd say, look, gone are the days.
Total expense ratio, TER, means all the costs involved
Correct.
in holding the product.
Exactly.
So
all the administration, the settlement costs, moving
it's
it
not
around.
just a management fee.
Yes.
It's all-in cost.
Correct. Just like a mutual fund would probably have a management fee as well.
So I mean,
I'd say those are the three big, Lisa.
Yeah. As well as the problem that they custody with Coinbase, and that this becomes a structural risk in itself, potentially. But that's not necessarily the ETF's fault, but I mean, it's a dependent risk.
No. Look, it's certainly worth noting. Look, there's always a risk with Coinbase, but look, they are custodying it. And the experience I've had is, even with the creation or redemption, and you need to move your physical Bitcoin around with Coinbase, it's so protected. One, it's on an air-gapped machine. Two, it's basically you have to do a video call with them. And there's very few people who are allowed internally to move this Bitcoin around. Three, you basically have a key with your thumbprint that allows you to be that person who does a creation redemption to move the Bitcoin around with Coinbase. The risk of Coinbase Prime, that going bankrupt, there is always a risk. But currently, with Coinbase listed on the NASDAQ, approved by the SEC, I mean, they were also under investigation. I had a Wells notice from the SEC, so there's always some risk, but they've managed to get through that. And basically, what I'd say is, if something happens to Coinbase, I mean, it's going to have a major impact on crypto.
Yeah.
So I'd say, famous last words. Coinbase isn't one of the risks I would look at. Maybe one of the smaller exchanges, like a tier 3 type exchange. I'm not going to name them because I don't know if anyone's working here, but I'd look at the more smaller ones, the ones who aren't fully regulated. I'm sure the Coinbase accounts are audited regularly, especially now that they custody for the major ETF issuers globally.
Before we move on to Heusser, maybe there's another question for non-finance people. Would you please explain ETFs versus ETPs?
Yeah, so look, an exchange traded fund, it really covers your your equity style products. Very simple, very straightforward. Sometimes you have ETFs. So ETPs, exchange traded product, it could cover a very exotic product, and that could be a commodity. So let's choose something really interesting off the periodic table, like rhodium. In that particular case, and the way that's hedged, that's not allowed to be called a UCITS style product. So exchange traded funds are UCITS. Yeah, and I'm going to let you break that down as to what it is. But it has a certain level of exposure, a certain level of sector exposure, and that can be defined within this UCITS structure, this regulated structure. But ETPs, they don't always fall into that UCITS style structure because they're covering a really, really exotic product like a commodity.
And I would say ETPs are like the overarching theme, exchange traded products. And then you have a subsegment, which are the ETFs, which are regulated funds.
Yes.
UCITS is a fund regulation in Europe. And then you have commodities, which are not covered by UCITS, as Gurjeet said, where you cannot do an ETF. And the same applies to Bitcoin. Bitcoin was not part of the UCITS framework, so that's why it was always an ETP. All the 21 share products were always ETPs and not ETFs. It's a different setup. It's a debt instrument versus a fund instrument, but the outcome for the client is more or less similar. It's just a technical difference in terms of regulation and technical structuring.
Absolutely, yeah.
Good. Answering also Gert's question whether if it's true that all ETFs are ETPs, but not all ETPs are ETFs. You
Correct.
just
Yeah,
explained
I'd
that.
say in a broad sense you could say that.
Good. Sana, you had a question. You raised your hand, but you then unraised your hand.
Yes. Yeah, I thought that was the last question for Gurjeet, but thanks, Lisa. You mentioned you mentioned the example of BlackRock for their iShares. My main question is, like, I mean, the mind-boggling thing for me is, so with all their clients basically buying and selling ETFs, that happens all off-chain basically. But what happens on-chain? Because that's the part I really don't understand when it comes to ETFs. So when intervene on-chain versus off-chain, because that's for me actually kind of the black box there.
Yeah, so I'd say let's just go through an example. Let's say you're a retail customer in the US. You want to buy the IBIT, so you buy $1,000 worth. You buy it on a like a public platform like Charles Schwab. Charles Schwab will start collecting all these orders, and they may end up trading with a specialist market maker. I'm not going to use any names yet. And that is where the hedging starts. So what can happen is that the market maker may already own that ETF hedged with a future, and nothing happens beyond that. But let's say this market maker has 0 positions. They now need to go sell $1,000 worth of the IBIT. They would now need to hedge that. So they have a position which is short ETF, long their hedge. But now they have to deliver those ETFs to those clients. So now they go to the ETF issuer to say, I want to create these ETFs. Here's $1,000, or here's the Bitcoin, which they initially hedged that ETF with. And now this is sort of where it comes down. Like, are those are the ETF issuers putting it all on chain? Sometimes they're not, because if you're trading with an exchange, do you call that on chain, or do you call DeFi, decentralized finance, on chain? But it's kind of where the Bitcoin gets traded. That's kind of where it becomes public, and I would say where it starts hitting the tape. And I think that's what you're referring to as on chain. So, for example, if a market maker starts buying Bitcoin to hedge that particular ETF on Binance or Coinbase, that's really where the crypto starts getting touched.
Okay, thank you, Gurjeet.
Then Adriano.
Yeah, just a quick one, Gurjeet. You mentioned about NAV, and
Yeah.
some of us are familiar with that term. Maybe other people in the call are not. Even more interestingly, what happens if there is, as very often there is, a divergence between the actual value of the ETF basket and the NAV, and how is that adjusted for? What type of operation are done by the asset manager or authorized participant to address that?
Yeah, so this is where the market makers come in, because what you'll find is that, let's say throughout the day, you've got a market maker quoting to an exchange, a two-way price, and this is for the ETF. If there's a lot of demand, you'll tend to see that the market makers start skewing their prices up, which means it is deviating from the Bitcoin price. So it's trading at a premium. And if there's a lot of selling demand, it starts trading at a discount. But this is sort of where the market maker starts generating excess returns over any market making fees, because they can capture that premium or discount. Whether they pass it on to the end client is really down to the market maker. However, NAV stands for net asset value. And at the end of the day, the price of the ETF is fixed. And it's in the prospectus. So usually in Europe, it's 5 p.m. CET. For the US, it could be 4 p.m. ET. And basically, that's just a point where they take a snap of the price of the underlying, and then they calculate what the value of the ETF is with that closing price or the NAV price. That's that is already pre-discussed in the prospectus, because what will happen is they won't just say we take the final price at 4 p.m. of Coinbase. They have to use 3 different exchanges depending on the prospectus. So it could be Coinbase, Binance, Kraken, or it could be any other one. And you have to take an average of those 3, and that's sort of where the NAV gets calculated. But whether it trades at a premium or discount, look, if you're a buyer, when everybody's selling, you're going to technically get to buy it at a discount. But usually everybody buys when everybody buys, and it's usually the market maker who captures that. But in capturing that premium or discount, they kind of push the ETF back to the NAV. And there's 2 terms. There's NAV, which is at the end of the day, and we have an INAV, intraday NAV. And so that's really what the market makers are watching.
And normally, this premium or discount is more prevalent in illiquid underlyings, right? It's in commodities, because in equities, if the market is open, you can trade it. After closing with equities, you get this discount and premium as well. But Bitcoin is traded 24/7. So why is there a premium or discount? And how big is this premium discount for Bitcoin ETFs? Do you have any numbers?
Yeah, look, if it's something like Bitcoin, which is very liquid, I mean, you're talking maybe 5-10 basis points maximum intraday.
Basis points is 0.05%, 0.1%.
Yes. But if you're looking at, and that would be for a fraction of a second because it would get arbitraged away. But if you're looking at something like an altcoin, and let's use a good one like Trump, when that was issued, you would see that trade at like a massive premium, or the Solana ETF, when everybody was jumping on top of Solana. And the Solana meme coins, the ETF would break away by quite a lot, and that could be 20 or 30 basis points, so 0.2% or 0.3%. If there's something structurally wrong, like an exchange is shut down, that is when you really start to see 1% or 2% or 3%. That's very rare. But coming back to your point, Jan, Bitcoin trades 24/7, but the ETFs, they trade at the exchange hours. So, Euronext would be, 8 a.m. CET to 4:35 or 5 p.m. CET.
I have CET4.
Yeah.
Okay, yeah, thanks. Any other questions? Otherwise, we will move on to Heusser, because the other question about Paperbitcoins is, do these crypto exchanges have as well the Bitcoins? And before we go into more questions over that, I think we can summarize, or if there are still some open ones, we can discuss it afterwards. But I really would love to hand over to Heusser now to give a short introduction as well, and then tell us more about this Deutsche crypto exchanges and why it's not safe to keep your Bitcoins on exchange.
Thanks for the intro, Jan. Quickly to me, Jan and I, we worked together at Crypto Finance. I ran the trading desk there, and later on I moved to a market maker here in Switzerland, and then I ended up with Sentora, which is a back again a proper crypto company, no regulation, everything offshore and mostly on chain. So I think to start with the Bitcoins on exchange, I would like to use one word Gurjeet was using, wrapping, or the wrapper. This is where creation and redemption is happening. This is one of the frictions that might get people to think there is paper Bitcoin around and people can just buy and sell these shares of ETFs, but there is nothing behind. Now, for exchanges, we heard the input from some users saying, well, I can just sell Bitcoin on an exchange. I don't need to have it, do I? I can just sell. And in the early days, I'm pretty sure some of the exchanges worked that way, with omnibus accounts and users not needed to fully fund their accounts to buy or sell. And the exchange later on settled everything. And most of the time it worked out. And then in some cases it did not. Now, to make it very clear what I mean with there is no paper Bitcoin on a properly functioning spot exchange, it means that the exchange will only give you access to the physical spot market if you have your account funded, meaning you either have stables or fiat to buy, so you can put in a bid to buy Bitcoin, or you have the Bitcoins in your account of the exchange, so you're allowed to enter a sell order to sell Bitcoins. Now, there are two different things: having the Bitcoin or the stablecoin on chain versus seeing it in your exchange account. The exchange is running like a bank, an internal ledger, and your fiat or your stablecoins or your Bitcoins are on chain. Well, the fiat not, but the rest is on chain. But that stuff is not on chain on every single user account. It's in an omnibus account. So Coinbase or Kraken, they run massively large omnibus accounts where the stable coins are sitting in and where the Bitcoins are sitting. Some of that stuff is even segregated into cold wallets, like not very quickly movable, versus the hot wallets where the exchange is using it to settle trades. So if the exchange is working in a proper fashion, they have to have, at the end of every day, when they close their balance sheet, they have to have the Bitcoins in the omnibus account on balance sheet versus their ledger balances of all the users. It has to match. I stop here quickly, and then I can move on into like margin trading. But maybe there are already some questions.
Maybe a question from my side. Does it matter for this topic if an exchange is regulated or not? Because if you're not regulated, if you don't have a bank account, you can't do fractional banking. So I would say most of the crypto exchanges nowadays who have some kind of a license are not allowed to offer fractional banking. Is that correct?
That's correct. They're not allowed to work on credit. So any exchange that has a license and is offering margin trading, the margin trading cannot come from fractional reserve. The margin trading comes from other users' coins. So if
Which they
I'm
lend on
yes,
purpose
but
to make their yield.
you as a user gave consent that
Yeah,
you
exactly.
are happy to put your Solana or your Bitcoins into the lending market, and you earn a small interest rate, but that's the stack the exchange are allowed to use to give to the margin trading guys.
Yeah. So they're not just playing around with my Bitcoins, but I have to do it on purpose. I have to consent.
Correct. Except FTX.
Yeah. Were they regulated?
No, not the
Maybe in the
international
Bahamas.
exchange. Yeah.
So, Patrick, in your opinion, I mean, this proof of reserves has come up as basically the pendant to proof of work in Bitcoin. So to make sure that the exchanges are running properly. Joking here, obviously, I know it's not the same. But so how meaningful is this proof of reserves as a transparency mechanism, and can it really ensure that the exchanges are running properly?
From my personal experience, I think it's not very helpful. It's very intransparent how they get to the actual final balance, and it's way above my head how technical it is to actually create this proof of reserve graph to say, oh, this is actually what we are holding in total as an exchange. Plus, it's always a snapshot. Your exchange is running 24/7 and you trade billions of dollars every other, I don't know, 6 hours. So it's like it's a snapshot of a day, a week, or a month ago, and I don't think it means much, but it's something they could come up very quickly in sort of saying, well, we do have some sort of an on-chain audit. You don't even need a big four company telling you you have the money. Oh, it's all on chain. I can show it to you. I'm not a fan of it, but it's there.
And maybe, and they have the same problems and risks as normal banks. If you have a bank run, if you have an issue with your credibility or your reputation, the clients are starting to pull the Bitcoins. And maybe some of them you have lent to others, and then you run into a liquidity crunch. And then you're struggling to pay out, or you have delays of 12 hours, 24 hours to get to cold storage and confirm transactions to move them out. But more people are asking for it because maybe you know that better, Heusser, but what is like some exchanges have 90%, 95% of their assets, of the client's assets in cold storage with a 12 or 24 hour delay. So if now everyone starts to pull and they can't pay that out quickly enough, rumors start to spread, and they have the assets, they can't just access it that fast, right?
That's correct. And it happens, I don't know, maybe every 1 or 2 years that you hear on Twitter rumors that an exchange is insolvent because it's not paying out. And then 6 hours or 12 hours later, it's over and people got their coins. And operationally, it's not that easy. And in the early days, and Gurjeet knows it as a market maker, that was your biggest issue, because when the market goes wild, you're on one exchange long the coin, short the stables, and on the other exchange the other way around, and you had to recycle, but you couldn't get the coins moving, and so you couldn't reload your accounts, and then you had to pull your market making prices off the exchange, which even made it worse, and the market was more volatile. Now, most of the larger trading companies, they don't use on-exchange balances anymore. They have a custodian that has an agreement with the exchange to mirror your balance up to the exchange, and you do settlement cycles. And I have negotiated one of these contracts for Sentora, Komenu, OKX. And funny enough, it is really, really difficult for the exchanges, because even if there is this contract saying my balance it's in Komenu and my account shows that balance, the exchange cannot be short those Bitcoins. Even if it's off platform somewhere else, they have to have it. So OKX is only willing to go as big as their Bitcoin treasury is, to basically pledge their treasury coins for the gap, for the shortfall. So it's still, even though you have this solution, it doesn't connect to the platform properly. So the exchange cannot fully utilize this new setup, which is very odd. I think it's weird, but they block it, and they block it for good reasons, because if something goes on the platform and a lot of people want the Bitcoins and they can't deliver, and then for whatever reason my Komenu account is frozen and I can't deliver, they have an issue. They can always sell well, but it's all sitting in Komenu, but I can't get it. You don't want to hear this, do you? So it's this on-chain, having assets on-chain in a non-fractional reserve system is really, really difficult to keep running in a high pace.
Yeah, I think as a private individual, it's much easier to have it on your ledger or Trezor than an institutional who needs to move funds all the time, 24/7, right? And can go in different ways, which you are not controlling, as you said before. Noe had a very good question. Could proof of reserve be viewed as audit theater, since an exchange could provide an on-chain snapshot of reserves, excluding potential debts? So they have the assets, but they have the debt on the other side.
Yeah, that's what I always mentioned in some of my reports when we talked about proof of reserve. You only have one side of the balance sheet, and full stop. That's what it is.
Yeah, thank you. Lisa, do you have any questions, or anyone?
I do, but maybe for a later point in time, because I kind of want to compare ETFs and exchanges. So maybe someone else has a question. Adriano?
Yeah, I mean, it applies also to what Patrick was saying. I was asking also on the chat to Gurjeet how AP validate and provide guarantees on price feed, since the snapshot that is taken at 4 p.m. determines the price of the ETF, and therefore any discrepancy from NAV. But that could be extended to Patrick as well, so it's kind of like double-sided. How do you guarantee price feed when you are looking at debt exposure, like margin calls and alike at the exchange? Like, it seems like that is pretty much driving the whole game, because if the price feed is incorrect, then everything else falls apart. So I don't know who wants to go first.
Yeah, I'll start with the ETF piece, but it's just to really understand the question so I can answer it how you want. So the ETF issuer, their main job is to make sure that the demand for the ETF is fulfilled. So if somebody has bought 1 million units of ETF, they have to deliver 1 unit of ETFs. And in the middle sits the market maker. The market maker has two roles. It's the primary side, which is the creation redemption, and the secondary side. So they are under obligation to the ETF issuer to say that they are going to guarantee price feeds to the exchange. And if they do not fulfill that, the exchange, so usually you have a tolerance of 5%. So you have to quote 95% of the day. And if you miss that, the exchange holds the market maker to account. And trust me, on a very volatile day, you have to maintain those spreads. Otherwise, you lose your reputation with the exchange, the reputation with the ETF issuer. And it's very easy for an ETF issuer to cancel an authorized participant agreement and find another market maker. I'm not sure if that helps, Adriano.
Yeah, it was more like, how do you guarantee that the price that is being quoted is reflective of the actual current market price? And it could be answered in two ways. Like, if you look at it, is 1 or 2 or 3 feeds enough to say this is the current market price? Or you can say, is what I'm receiving valid, and how do I ensure that, right? There are two ways.
Yeah, so an ETF market maker, for example, they would use as many price feeds as they can from all the various exchanges. You would even take prices from other market makers. But in addition, you might take the futures price, the Bitcoin perpetuals, the CME future. So a market maker would take as many intraday price feeds as possible.
Yeah, it was more for the audience to kind of understand the complexity around it, because it seems like, okay, you're getting the price, but there is some work behind it, right?
But as mentioned, Adriano, with Bitcoin, it's a little bit easier because everybody's pricing Bitcoin. But as you come down the list, the ranking, as you get to the smaller coins, like, I don't know, like Trump, Melania, I'll just keep using that as an example. You get fewer and fewer market makers. And you get some of the more, like the AI coins, like Fetch AI, for example. And so as you get fewer and fewer spot market makers, it becomes harder and harder for an ETF issuer to release the ETF. So even from a regulatory perspective, there has to be a minimum number of exchanges which quote the underlying, and there has to be a minimum number of market makers as well. So from a regulatory perspective, there's already a structure around an issuance of an ETF.
Yeah, and maybe to chip into this, this is always this is more art than science. What is the right price? What is the fair value of this asset? Some of you might remember the kimchi premia in Korea. So the Bitcoin price in Korean won was always trading, or at that time when Bitcoin was going up, it was always trading at a massive premium. And that was just structurally in that country, the way the supply was, the demand was higher than the supply. It traded up there. So for the Korean person trading or buying it, that was the price to buy it. There was no other fair value he could buy it. So it always depends as well a bit where you're sitting in terms of in the market structure. If you're a very small account retail on a not so sophisticated platform, your fair value price is way different than Gurjeet's market making firm that can buy or sell Bitcoin. It's just different. Not everybody has the same. The right is probably the wrong word, but has the same access points that makes it fair value.
Yeah.
So for equities, I mean, it's even easier to set the NAV, right? Because there you use the closing. And what is very important for the others in the audience is that institutional investors, they will not just buy on an exchange, buy and sell on an exchange. If they buy an SMI ETF where they have a few billions on it, they wait until the NAV, so they pre-announce to the issuer that they will redeem 1 billion Swiss francs in the SMI ETF, and then they will match that in the closing. So it will make the AP, probably it's with the AP, the buying and selling, they will match that all, execute that all in the closing auction, which happens from 5 to 5:15 or 5:15 to 5:30. And then this is the auction price afterwards is the one which counts. That's very easy compared to Bitcoin, where it's traded 24/7. It has no closing action, no opening auction. It's traded on several exchanges. As national levels can be different, national prices can be different due to several reasons. For me, it's very hard to assess that. And when we set up the first Bitcoin ETF, we built together with SIX an index which had several exchanges as underlyings, as data feeds, where we took the price from, and not only 4 p.m. snapshots, but 1 minute before 4 to 1 minute past 4, and then used a volume weighted average price of that. So really like to make it tradable and hatchable, because if the price drops, and that's as well one of the claims from this Twitter account, from this Twitter message, which kind of created this whole stir and nervosity and rumors around the Bitcoin ETFs, that Chain Street, which is one of the APs, is always driving the prices down around the opening and influencing the price. This is not possible in an auction or over a longer sustainable period. But maybe Gurjeet and Heusser, maybe you can answer that. So is Chain Street manipulating the market, or is it more like it's just they have a specific role which they have and can do certain things?
I'll cut sort of coming from my side, my experience, and I'll hand over to you, Paddy. Look, it's a market maker's job to generate revenue. That's what they do. They're not a charity, and a lot of the things they do are arbitrage. However, to move the price of an asset which already trades billions in a day I mean, they would have to use significant size over multiple exchanges to impact the price of an ETF. However, I'm not saying they cannot do it, but also one of the things a lot of people forget is that they're not just quoting ETFs, they're quoting options. So they might have gamma positions, which they're going to hedge. You know, they've got structured products. And I'm not going to mention the asset manager, but in the past where I've had to hedge MSCI emerging markets, for a particular asset manager, they wanted me to execute at 1 p.m. CET every day. And I said, that's the worst time to do it. It's illiquid. And they said, but that's the prospectus. That's what we have to do. And I had to match the price. But also, as a market maker, I have an obligation, a fiduciary responsibility to not impact the price too much. Because if I start creating too much volatility in the NAV of that structured product, clients won't buy it anymore. So you kind of, there's this kind of narrow space where as a market maker, you're supposed to generate revenue, but you're also under obligation to maintain an orderly market. Were they manipulating? It's a gray area. Can they manipulate? Yes. Were they doing specifically what this Twitter account said? It's hard to say because there's so many different moving parts. You'd have to know all of the parts. And I'm fairly sure even the people who work at the market making firms do not see all of the parts.
Yeah.
I hope that helps, Jan.
Maybe I bring in a story from the old days. I worked for a big Swiss bank, and we traded interest rate futures. We traded the euro curve, the dollar curve, the Swissy curve. And at a particular time in the day, usually in the morning, the issuance desk had to issue bonds. Swiss bonds, euro bonds, dollar bonds were in the afternoon. Whenever there was a big issuance going on, they asked us to make sure that the curve doesn't move. So I can't control the curve, but what I can do as a market maker, I can put in massively large orders on future exchanges to basically tell the market, I'm here, it's not moving. And it could be similar to Jane Street, that they have fixings or they have structured product issuance at that particular point in the day. They like it to be slightly higher or lower, so that's why they either buy or sell at that particular time. The price gets fixed. The structured desk of Jane Street makes a lot of money. They get some rebates to the market making side because it's not going to be for free for them. So it's the same people that traded in TradFi are now trading the crypto market, and it's the same games. It hasn't changed. Just because it's a new asset and it's on chain, the game is still the same, as Gurjeet is saying. We're here. Well, the market makers are here to make money. Period.
But at the same time, the market makers are improving the situation for retail investors as well, because they bring efficiency to the market. When there's a discount, they start to buy to meet the INAV. If there's a premium, they start to sell to meet the INAV again. So this is something which you can always discuss, then they make a profit. Yeah, you can as well. They just, as Gurjeet said before, we're talking about 10 basis points. It's 0.1%. It's nothing for you. But if they move billions, it counts. So they're not the bad guys. They are here to make money, but with making money, it improves the market overall, right?
Nicely put.
Absolutely.
Is this related to what happened on October 10th?
Ooh.
What happened on October 10th?
That goes really deep into market structure of crypto exchanges. It's the so-called ADL, auto deleveraging system. Some of you might remember the days when OKX, I think it was 2019, when OKX had a huge whale in the perp market, and the guy was bigger than the whole order book. That was on perps, yeah.
What are perps?
Oh, sorry, perpetual futures, like futures with not a term date,
So
like CFDs.
Running endless.
Exactly. So the market stopped for 3 weeks because that whale got liquidated, and the order book wasn't able to absorb the liquidation of that whale. So the platform didn't know what to do. And that was one of the first large socialized losses that went through the whole market. So if you were on the right side of the trade, you were in positive unrealized P&L on your per position. Your position got closed without you doing anything to reduce the whale liquidation amount. So ADL is exactly that. So traders that have massive gains on their derivatives get closed out, versus the massive losses on the other side of some positions get closed out. And that can, if you are a market maker, and this is one leg of your whole trade structure of your hedge, and you lose that leg, you're unhedged. And if you don't know when it happens and how much it happened, it's going to be really difficult for these large market makers to figure out what their position is. And if the market just goes down and you don't know how long you are as a market maker, you start to panic as well, and you start to sell, and you pull your prices. And then the ADL gets worse and worse because a lot more people are in really bad places, and other people are in really good places, and those positions just get closed. And there are off-chain contracts of some trading accounts that get excluded of the ADL. So there you have a two-tier sort of customer base.
Okay. Yeah, I'm not commenting on that. But maybe one question which is directed to Gurjeet is, when the Bitcoin ETFs were approved, the regulator said they can only do cash creation. So the market maker sent funds to the custodian bought the Bitcoins and confirmed it back to the market maker and ensure that we have the Bitcoins, you can hand out the funds. So there was really a transaction on an exchange. Nowadays, you have as well in-kind creation. So the AP doesn't need to send the money anymore. They can send a Bitcoin to the custodian, and then they can trade it. So there's maybe not a transaction anymore, which you can see on the exchange on trading volumes. Is that good or bad?
I'd say when you're the way we look at it is, if you're doing a cash creation or a physical in-kind creation, the difference for the market maker is really just the fees. So if we're actually doing a cash creation, it means that you're executing something on an exchange, buying or selling, and you have a transaction fee, a settlement fee. But if you're doing an in-kind creation, let's say it's Bitcoin, you're just sending it from one wallet to another wallet. And so that fees is basically minimal. So the market maker gets to keep a lot more of their market making fees. That's really it, because it doesn't really impact the retailer. So it's very much the relationship between the market maker and the ETF issuer. If I go back and I try to remember why they started with cash creations, it's a long time ago, I think it's very difficult to verify where the Bitcoin could have come from initially. But now, because everything's verified, there's a lot of auditing going on, I think the regulators are a bit more comfortable knowing that specific market makers have to have their Bitcoin audited. I think it's referred, and Patrick, please jump in here, the travel rule or something.
Yeah.
And if that hasn't been approved, then you're kind of stuck. But Paddy, I don't know if you've got any additional to add here.
I think the custodians wanted to have the power over the source of the Bitcoins and make sure that they're not getting tainted by any dirty coins sent in. But at the same time, obviously, if you have to send fiat to the custodian to buy it, you're as well bound to banking hours and banking days, which in-kind creation or redemption, you can just transfer them 24/7, which improves the market efficiency, price finding. It reduces probably as well a bit the premia and the discounts. So in my opinion, yes, you don't see each individual trade on Coinbase anymore for the ETFs, but it improves the overall efficiency of this whole issuing and redeeming of fund shares.
So we are 1 hour in, and we have not defined the term paper Bitcoin yet. So let us jump back to the very beginning. So how would you define the term paper Bitcoin? Is it useful, or are we all mixing several things together when we use the term paper Bitcoin? So I would like to hear both answers.
Okay, let me start. I think paper Bitcoin is not a useful expression. You would need to add a lot more context to what you think a paper Bitcoin is. Like an ETF share, to me, could be a paper Bitcoin. Exchanges, I'm still standing by that. Exchanges, like the big ones, tier 1 exchanges, they cannot facilitate paper Bitcoin trading. The trading on a spot order book of a tier 1 exchange is physically backed, full stop. Gurjeet?
Yeah, look, I agree with that. If you buy Bitcoin on an exchange, one of the tier 1s, like the Binance or Coinbases, this is not financial advice. I'm not trying to send you to any exchange. I don't get a kickback. Yes, you should have, it's hard to say the physical Bitcoin, because you should be able to move it off to a wallet. Coming back to what Patrick said with the ETF, yes, you've got the exposure 1-for-1, but you're still one step removed from holding that Bitcoin. Where I think, you've got real paper Bitcoin are like certificates, turbo certificates, and contract for differences, where you've got these kind of spread bets. That's real paper. And look, there are some, I'd even say there were some neobanks back in the day who said you could trade crypto with us, but it does say this is synthetic exposure. So you don't actually own the Bitcoin, so you can't send it anywhere. And there was no way of sending it anywhere. But Patrick can confirm on exchanges, you have an on-ramp and an off-ramp. And I think that's a really important thing. So with Bitcoin, you should be able to on-ramp it and off-ramp it, which means taking it off the exchange and putting it back on. You can't physically hold it, but you can definitely move it around and you can see it. And I'd say the custodians can verify that. And if you have your own Trezor or Ledger, once again, not pushing any particular type of wallet, you should be able to move it there and see that on chain. I hope that helps.
So, I mean, in your opinion, would you say that the larger systemic risk comes from ETFs or from centralized exchanges?
Good question. Look, I've been doing ETFs a long time, and ETFs have had, what they're saying about crypto now is what they used to say about ETFs 25 years ago. But during COVID, it was the ETF creation redemption market that helped keep the bond market together. That's a much sort of bigger sort of story there. I kind of see that ETFs themselves, you can't create the ETF unless you back it with the physical Bitcoin. If it's a synthetic ETF, that's a whole different story. And anybody who buys an ETF, you should read the prospectus. You should understand what you're buying. Coming back to what Patrick mentioned about auto deleveraging, you signed up to an exchange. Everyone probably just fast forwards all the way down and clicks terms and conditions accept. But when it actually impacts your P&L, that's when people start looking into it. And I'm sure that's a similar thing that happened at the global financial crisis as well. People didn't really understand what they were buying and selling. And I think this is where the paper Bitcoin term and the Bitcoin term, it starts separating semi-professionals and professionals. I'll just go and say that we're all kind of professionals here and we understand a little bit more about finance than, some other people. And those are the people I think it really impacts. Because for me, if I'm trading a CFD, I know I'm getting 5x leverage, but it's not really Bitcoin behind it. And I would never really expect to move it. But one day somebody might try and move their Bitcoin off a CFD style product or another synthetic style product, and might not be able to do it, but they haven't read the particular prospectus. So for me, if it's not Bitcoin that you can move off to a wallet, it's paper.
So you said what is more of a structural risk, right? Exchanges or ETFs. Now, I had a lot of discussions with Dr. Levin Böhmke, where he said the price is not important. And when you were pointing out the structural risk, you were pointing into price, right?
Not necessarily. No.
Okay, not necessarily.
No.
But then the question can be answered completely different than what Gurjeet just was mentioning it.
Mhm.
I don't think either exchange or ETF is a structural risk for Bitcoin. If an exchange goes completely down or bust, well, the Bitcoins are still somewhere on chain. Maybe it has changed hands unwillingly, but they're still there. Similar to the ETF, if the ETF falls apart, price deviates, and it all goes to shit, and people just don't want to have that ETF share anymore, the Bitcoin network doesn't give a rat's ass about it. The Bitcoins are still there. Maybe not in the hands of the guys who thought they have it, but it's still there. So structurally, I think there are other risks out there that might be worth discussing, but again, that goes way above my head.
Like the custody solutions.
I'm not even going to go there.
That would be the topic for the next webinar, right?
Do you have to invite Levin Böhmke then?
Yes, we can surely do that. Okay, thanks for the opinions. So 15 minutes left in this call. So I would really like to give the stage also to our audience. We have had several voices already, but I'm sure many of you still have questions. They can also be super basic. You can also ask again, but I still don't understand what an ETF is. We're happy to re-answer that. So please don't be afraid to ask questions.
In the meantime, maybe there's a question from Paul in the chat. Gurjeet, do you know what currently the fraction is of the volume in cash versus in kind?
Yeah, look, typically you're looking at, easily the top 70 to 80% is still cash creations.
Still,
yeah.
oh wow.
Yeah.
I thought it's like 70-80% in kind.
Not everyone does it. The thing is, if you need to be holding the Bitcoin already to place it in kind, the thing is, you can send the Bitcoin within minutes or seconds, but the ETF is still T+2 because it's on the traditional finance network. So no one wants to have that mismatch, between settlements. So unless you can get the ETF settled T0 as well, because the Bitcoin you can send T+0, trading day settlement in today. But typically in the traditional world, you're talking T+2, T+1 settlement. The quickest is T+1. So if it's really large size, we're talking billions, then it's probably more efficient to do in kind. But if you're talking smaller sizes and typical creation redemptions throughout the day, could be anywhere from $20 million to 50 million. You know, the difference between the P&L and, you know, the what you're going to save from an in-kind creation, it's kind of minimal.
Thanks very much. Rahim?
Good evening. My question is, the term Paperbitcoin only seems to in part refer to a lack of understanding of financial markets. I think the more important aspect is a fear about decreasing fungibility in the future, that there could be a future where there's this Bitcoin-backed financial product that is part of a highly regulated world under more and more surveillance, and the link is broken eventually with the real Bitcoin or original Bitcoin. It could even go in the direction of fork that's pushed through, that then there's like this controllable kind of Bitcoin, and it only becomes a regular asset like any other asset. Do you see any tendencies along this way, and what could prevent this scenario from happening?
From an ETF perspective, I think if you look in the prospectus, they have tried to cover this. So if there is a fork in Bitcoin, the ETF issuer will make a decision which road they go down. And, you know, it's a really good question, but it goes quite deep into, you know, blockchain and how, you know, if a blockchain gets hacked, how they kind of, you know, deviate down a different path, as you mentioned, fork. But in an ETF prospectus, it's already there. So yes, it could be something that's a risk, but the devil is in the details. So if you're buying the ETF and you've read the prospectus, and nobody does because it's many different pages, you would be aware of that type of risk. A similar point is recently the price of silver has exploded. And what they found is that the ETFs couldn't meet the physical delivery. And in the product prospectus, it allows the ETF issuer to decide whether they deliver it, and if they deliver it 4 weeks later, or they change the price to cash or spot. So all these scenarios are actually accounted for. It's just if you trade that particular product, highly volatile product, you need to read the prospectus. And then going down whether it's right or wrong, that's a whole kind of morality question. But look, I think if you're a retail punter who just wants exposure, you know, I wouldn't bet the house on it. But if you're really deep and you want to kind of change your life with Bitcoin, then it's worth really understanding it, how exchanges work, how wallets work, and just go buy the Bitcoin and physically hold it. But for other people, you know, they just need some quick exposure, or they like it and they, you know, they had a chat with a taxi driver one day and he mentioned it, and now they just want some exposure for a couple of €1,000.
Thanks.
From a price point of view, we have seen this a few months back when privacy coins started to move aggressively higher. I am not in a position to talk about the tech, what would happen on the Bitcoin side, or how the community would reorganize around a potential fork to have more privacy in the new forked coin. I think the first move you would see is people selling their Bitcoins and buying a privacy coin. But I'm not that deep into cypherpunk and privacy, so I wouldn't be that person who would protect myself on top of owning Bitcoin, also having a privacy coin, because I'm so afraid that the bad TradFi world is trying to get to my money. I feel comfortable enough just owning Bitcoin, and people can know that I own Bitcoin, but they wouldn't necessarily know on which address I hold them or where I store them.
Yeah, thanks very much.
Thanks.
Lothar had, sorry, Rahim, you want to say something else? No.
Okay,
Fine.
good.
Thank you.
Lothar, you had a question?
Yeah, thank you. Well, moving a little bit in the direction of, if you could, let's say, imagine a Bitcoin ETF offering yield through options or any other structures, would you then consider that still Bitcoin or paper Bitcoin in a design?
It's a good question. Look, I think if it's still physically backed, and let's keep it very vanilla, you can. It's a really good question. You can basically, let's say you work with a custodian and you stake the Bitcoin there. You can generate a yield of 2 or 3%, and the ETF issuer can pass that back through to the ETF. But there are other ways of staking your ETF, and this is where we go down a rabbit hole, because you could turn, your BTC into wrapped BTC, stake it on Aave and earn an even higher yield. But at that point, could Aave, the protocol, get hacked? Yes. Do you start adding more risk? So we're kind of going down a rabbit hole, and I think Lisa's got at least 5 more sessions to set up now. So
Yeah, I would say if you buy a Bitcoin in that ETF, and that ETF does some funky stuff with selling options, a cover call strategy, and the cover call strategy goes wrong, you are not able to get your 1 Bitcoin back because the fund lost money overall with that strategy. I would label it as a paper Bitcoin strategy, because for whatever reason you're not getting back at least your amount you put in. So I would be very careful in any sort of strategies that offer you more yield for a risk that is not capital protection, but just gambling with your money.
Well, thank you. Yeah.
I have one question, which is probably very controversial to Gurjeet and Heusser. Does the 21 million cap still mean what Bitcoiners think it means, given the financial layer built on top of it? Do we get diluted, or are there still 21 million?
I can go, Paddy. Yeah, look, 21 million that's all that's ever going to be created, and apparently we hit 20 million. So there's 1 million that will be mined over the next 100 years. But what's interesting is that 5 million are lost. And I don't know if you know the fantastic story of the guy who had like 1,000 Bitcoin on a hard drive and threw it in a garbage bin, or threw his PC away, and now he's still digging it up, and that's worth, I don't know, hundreds of millions or even $1 billion. But let's just say, if you like Bitcoin and you own it and you hold it, that's one thing. If you start creating derivatives on top of derivatives, we've seen this before, like CDO squared, there will be a risk. But it comes back to one thing. Every time, I think someone mentioned the 10th of October last year, fine, there was auto deleveraging, there was margin risk, the market moved quickly, but blockchain worked. It did exactly what it was supposed to do. In the global financial crisis, the swap sort of protection, the protections that people thought they had weren't there. The banks didn't have the collateral behind what they said they had. With crypto blockchain, you can't really lie if it's on the blockchain. I'm not sure if that answers the question, Jan, but I'll hand over to Patrick.
If you own the coins, if you have it on your wallet, then there's no bank in between, because you can hold the end product, right? Yes, Heusser.
Yeah, I think that is exactly the difference. So in gold markets, there is also a finite amount of gold that is around. Yes, they still dig out, but there's a finite amount of gold, but there is a massive derivative market on top of it. And the problem is, and I know this, some of the traders I sat next to during the financial crisis, they started to buy gold and shipped it to their home, to their treasure in the cellar, because they said, if the shit hits the fan, the gold in my bank is worth zero. So for the Bitcoins, it's the same thing. If there are structured products on top of it, options markets, futures markets, whatever, as long as you are trading the physical underlying and you hold it, self-custodying it, the market can go absolutely crazy and the price goes down, but your one Bitcoin is still one Bitcoin. You don't have to worry about that. Where with pretty much any other financial instrument, even if you hold the underlying instrument, you cannot self-custody it. So you still have 1 or 2 layers of risk, which you cannot determine if it will ever be there if the shit hits the fan.
Amazing answer.
Yeah,
Thanks
I think
very
that could even be an amazing end of today's session. So self-custody is the way. We all knew it since the beginning. Good. So yeah, so that's also Noah's conclusion. So physical Bitcoin, I mean physical, it's not really physical, right? It's still digital, but in that sense, self-custody is the way to go. But please all make sure that you know what the best practices are, because there are also some risks involved there. So that's also important to upskill yourselves in this regard. Yes, so I would actually really use this as a closing note. Any final remarks from Patrick, Gurjeet, Jan?
No, thanks for the invite.
Yeah, thank you. It's fun.
Yeah, thanks to both of you. Thanks for Lisa for moderating. I had a lot of fun. I really enjoyed the topic. It's one of the topics I can talk about, less about the technical aspects of Bitcoin. There I'm gonna hand it over to some other people, but here it was really great. I hope many of you learned something. I'm sure you can reach out to those guys on Twitter or on other profiles. Yes, so thanks very much, Gurjeet. Thank you very much, Heusser. Back to you, Lisa.
Thank you. And I wish you all a great evening. Please consider becoming members of the Bitcoin Association if you are not already members. And then feel also free to share some future topics that we can organize. So thank you everyone for joining. Have a good evening.
Thanks, everyone.
Bye-bye.